On August 22nd, Federal Reserve Chairman Jerome Powell delivered a blockbuster speech at the Jackson Hole Economic Symposium, shaking up global capital markets. He sent a clear, dovish message suggesting an interest rate cut at the Fed's September meeting. The news sent U.S. stocks into a frenzy. The S&P 500 index soared to a record high. Tech, small cap, and financial stocks all surged. Gold prices also surged. Investors were secretly rejoicing. Don't miss this opportunity for a rate cut. Why did Powell trigger such a strong market reaction? He addressed the U.S. economic slowdown and the downside risks in the job market. He also explicitly stated that the Fed would adjust monetary policy more flexibly rather than relying solely on a single economic indicator. This means capital could rapidly shift in the market, from sectors pressured by high interest rates to those most vulnerable to rate cuts. Today, we will analyze Powell's speech in conjunction with the market's immediate reaction and historical examples of interest rate cuts to provide an in-depth analysis. Why did U.S. stocks surge after the speech? Can tech and small-cap stocks continue to lead the market? Will gold, real estate, and cryptocurrencies be the next beneficiaries? How can investors use technical analysis to assess opportunities and risks? Hi, I'm Daryl Hart, a blogger who loves financial gossip. Did you know? In the capital market, every interest rate cut is like a signal flare. It ignites investor sentiment and could set the stage for either a multi-year bull market or a catastrophe. The question is, what will happen this time? First, let's put the current situation into context. After 2 years of frenzied interest rate hikes, the U.S. economy has finally reached a turning point. Inflation is cooling, economic growth is slowing, and labor market data isn't as strong as it was in the past 2 years. Against this backdrop, the Federal Reserve has begun signaling interest rate cuts. Many view this as good news, believing that lower capital costs will benefit the stock market, bond market, real estate, and even cryptocurrency. However, remember that history shows interest rate cuts aren't always good news. I'm reminded of the rate cut in 2001. The dot-com bubble had just burst, and the Nasdaq Composite Index reached 5,000 points in March 2000. However, it halved within a year, losing nearly 70%. In an attempt to stimulate the market, the Federal Reserve slashed interest rates from 6.5% to 1% from January 2001 to 2003. Imagine that. Almost free capital. But what was the result? Tech stocks didn't immediately rebound, but continued to decline over the next 2 years. Many investors believe that rate cuts signaled the beginning of a bull market, but they only saw their losses worsen. It wasn't until 2003 that the market truly bottomed out. Interest rate cuts are not always positive, especially when they are caused by an impending recession. Let's consider another example. The 2008 financial crisis. During that time, the Federal Reserve lowered interest rates from 5.25% to zero at an unprecedented speed. What about the stock market? The S&P 500 plummeted 38% in 2008, making it one of the worst years in history. However, by March 2009, the market had bottomed out. Over the next decade, the S&P 500 quadrupled. In other words, while interest rate cuts saved the market, their effects weren't immediate. They took time to develop. It's like a doctor giving a patient an injection. If the patient has a high fever, the doctor will immediately administer antipyretic medication, but the temperature won't immediately return to normal. It'll take several hours. More importantly, the doctor must understand the underlying cause of the patient illness. If it's just a minor cold, the medication will work quickly. But a more serious illness may require long-term treatment. The same is true with the Fed's interest rate cuts. If they're responding to a short-term economic slowdown, the market may rebound quickly. However, if they're triggered by a deep recession, the response will be much slower. That said, I'd like to share some data. Historically, the Fed has implemented several rounds of interest rate cuts. During the Volcker era in the early 1980s, U.S. interest rates reached as high as 20%. A series of rate cuts were necessary to bring inflation down. Over the next decade, the S&P 500 quintupled. Following the dot-com bubble of 2001, interest rates dropped from 6.5% to 1%. The S&P 500 fell for 2 years before rising again and not embarking on a new bull market until 2003. During the 2008 financial crisis, interest rates fell from 5.25% to 0%. The S&P 500 plummeted during the crisis but then entered a decade-long bull market. In 2019, the Federal Reserve began cutting rates, starting with a small cut from 2.5%. Shortly thereafter, the pandemic struck, sending interest rates straight back to zero. The stock market initially plummeted 35%, then experienced an epic rebound thanks to unlimited quantitative easing and fiscal stimulus. You'll notice an interesting pattern. Almost every interest rate cut is accompanied by significant uncertainty. In other words, rate cuts are not the end, but rather a sign of impending storms. Many investors are now asking, what will happen this time? Will it be like 2001, when the market fell even after a rate cut? Or will it resemble 2008, with a sharp drop followed by a surge? Or will it resemble 2019, when unexpected events accelerated the market into a new cycle? The answer may contain both echoes of the past and entirely new variables. Why? Because this economic environment is unique. On the one hand, U.S. inflation has not fully returned to the Fed's 2% target, and structural issues, such as energy prices and wage growth, persist. On the other hand, U.S. government debt has exceeded $34 trillion, and the fiscal deficit remains high. In other words, the Fed doesn't have much room to cut interest rates. The Fed needs to balance two seemingly conflicting goals: stabilizing growth and preventing inflation. This situation is reminiscent of the stagflation period of the 1970s, when U.S. economic growth was sluggish yet inflation remained high. The Federal Reserve attempted several rate cuts, only to see inflation rebound more violently. This ultimately forced a series of iron-blooded rate hikes during the Volcker era. This serves as a cautionary tale. If interest rates are cut prematurely, before inflation is truly tamed, the market may experience a temporary surge in excitement. However, there may be a greater cost later on. At this point, you might ask, what about the stock market? I'd like to make a more intuitive comparison here. Historically, the S&P 500's performance during interest rate cut cycles has varied greatly. When rate cuts are preventative, such as the small rate cut made by the Federal Reserve in 1995 to prevent the economy from overheating, the S&P 500 rises 34% within a year. However, if the rate cuts are reactive, such as in 2001 and 2008 when the economy was already in crisis, the market often experiences a deep decline before a bull market begins once the economy has stabilized. The key question now is this rate cut preventative or reactive? We just discussed the reasons behind the Fed's 25 basis point rate cut. You might think a rate cut is just a technical move. But in reality, a lot more is going on. Did you know? Looking back at history, each Fed rate cut is like dropping a stone into a pond. The resulting splashes and ripples are completely different each time. For example, consider the 2001 dot-com bubble burst. The Nasdaq hit 5,000 points, and almost everyone was buying tech stocks. Then the bubble burst, and the Fed immediately began cutting rates. From 6.5% at the beginning of 2001, rates plummeted all the way to 1% by 2003. That sounds like a big move, right? Yet the market didn't recover immediately. The S&P 500 continued to struggle during the first 2 years of rate cuts, particularly with tech stocks. How devastating was that? Many star companies simply vanished, and even giants like Microsoft and Cisco saw their stock prices linger at low levels for years. In other words, interest rate cuts aren't an instant solution. It takes time for the economy to recover. Let's look at the 2008 financial crisis. That was another extreme. The Federal Reserve slashed interest rates aggressively from 5.25% to zero. The S&P 500 initially plummeted in 2008, dropping approximately 37% for the year, one of the worst years in history. Interestingly, the real turning point occurred in 2009. As the market digested the impact of Lehman's bankruptcy and liquidity recovered, the S&P 500 rebounded in March 2009 and embarked on a decade-long bull market. While interest rate cuts in 2001 were a last-ditch effort to stop the bleeding, and their effects were slow to materialize, 2008 marked the beginning of the bull market. What about 2019? This is a more contemporary example. At that time, the U.S. economy was merely showing signs of recession, not collapsing. The Federal Reserve initiated a preemptive rate cut. The rate was lowered from 2.5% to 1.75%. Although the cut wasn't significant, its effect was noticeable. The market interpreted it as a sign that easing conditions would persist for a long time. Consequently, the S&P 500 reached new highs in 2019 and continued to do so even before the pandemic. This shows that the market's response to rate cuts depends not only on the size of the change, but also on the economic context. You might have noticed a pattern by now. Rate cuts themselves aren't the key. What matters are market expectations and the stage of the economy. If the economy is in a deep slump, as it was in 2008, a rate cut is merely a lifeline that takes time to bear fruit. However, if the economy is merely slowing, as it was in 2019, a rate cut is like adding fuel to an already favorable situation, instantly igniting market enthusiasm. Now, let's fast forward to 2025. The Fed's 25 basis point rate cut is, in some ways, more similar to 2019 than to 2008. While U.S. GDP has slowed and unemployment has risen, neither has reached crisis levels. Therefore, rather than panicking, the market has breathed a sigh of relief. Great. The Fed has finally taken action. Liquidity will become even looser. Consequently, the U.S. tech sector has taken off, and the S&P 500 has stabilized. However, many people haven't noticed a key detail. Historically, the strongest performers during each interest rate cut cycle aren't traditional industries, but rather growth assets. For instance, after 2001, tech stocks dropped sharply, but the tech sector continued to rebound fastest from 2003 to 2007. What about after 2008? Consider Apple, Amazon, and Google. Their market capitalizations increased by orders of magnitude from 2009 to 2019. Who benefited the most from 2019 to 2021? Again, tech leaders, particularly those in cloud computing and AI. In other words, the environment eased by interest rate cuts benefits future story stocks more. So the question is, what are the future stories now? Undoubtedly, AI and data centers. Just as the internet was in 2000, mobile internet in 2008, and cloud computing in 2020, the keywords for 2025 are AI computing power and memory chips. This explains why recent financial reports from companies like Micron and Nvidia have consistently triggered stock price surges. The capital market has linked interest rate cuts with the AI boom. When discussing the market impact of interest rate cuts, it's important to delve deeper and focus on specific sectors and investment opportunities. Did you know? During an interest rate cut cycle, market capital typically flows first to interest rate-sensitive, high-growth industries. Technology stocks are the first to react. For instance, when the Federal Reserve cut interest rates in 2019, the Nasdaq Composite Index rose 35%, while the S&P 500 rose 28%. Technology stocks significantly outperformed the broader market during this period. The logic behind this is simple. Technology companies often rely on financing and capital expenditures. Lower interest rates directly reduce financing costs, making expansion easier. You might ask, what about financial stocks? Many people assume that interest rate cuts are bad for banks due to narrowing interest rate spreads. However, the financial sector can benefit in the short term. Why? Because interest rate cuts stimulate economic activity, increase loan demand, energize the credit market, and boost overall bank business volume. Financial stocks have historically performed well in the short term during interest rate cut cycles like those in 2001 and 2019. However, long-term returns depend on the persistence of the interest rate curve. The real estate market is a prime example of this. Interest rate cuts lower mortgage rates, directly stimulating home purchase demand. Following the 2019 rate cut, the U.S. House Price Index reached a 10-year high within a year, with mortgage rates as low as 3.6%. For ordinary investors, this means lower barriers to homeownership and increased opportunities for real estate investment and leverage. The real estate sector has historically risen in tandem with each interest rate cut cycle, though the speed and magnitude of the rise vary depending on the economic environment. There are also many valuable lessons to learn from gold and other safe haven assets. For instance, during the 2008 financial crisis, gold surged from $700 to $1,900, an increase of over 170% after the Federal Reserve cut interest rates to zero. Rate cuts reduced the appeal of holding U.S. dollar assets, and amid increased economic uncertainty, gold naturally became a safe haven for capital. Similarly, during the pandemic of 2020, the Federal Reserve cut interest rates again, sending both gold and Bitcoin soaring. These examples demonstrate that, during periods of rate cuts, gold and other safe haven assets often attract significant capital inflows. Investors should pay attention to the performance of the U.S. dollar index. Historical data shows that the index weakens during almost every interest rate cut cycle as yields on U.S. dollar assets decline and international capital seeks higher-yielding markets. This occurred in 2001, 2008, and 2019. For investors seeking overseas asset allocation, this suggests that a balanced allocation to foreign exchange and emerging market stocks can yield additional returns. In addition to macroeconomic factors, technical analysis is a crucial tool for making investment decisions. Market breadth indicators can reveal the market's overall health. A simultaneous increase in most stocks suggests a stable market, while an increase in only a few leading stocks may indicate a localized hotspot. Trading volume verifies the authenticity of a trend. Increased volume and rising prices indicate sufficient capital inflows, while declining volume suggests an unsustainable market trend. The VIX, a barometer of market sentiment, typically declines after an interest rate cut. If it rises against the trend, it suggests that the market doubts the effectiveness of the rate cut and necessitates caution. In terms of investment strategy, I recommend a combination of core and tactical positions. Core positions should be held in high-quality tech stocks or index funds to ensure long-term returns. Tactical positions should be allocated flexibly to gold, real estate, cryptocurrencies, or short-term hot sectors in order to take advantage of policy opportunities. Furthermore, setting technical stop-loss orders and implementing a phased position-building strategy can mitigate risk effectively. Throughout every interest rate cut cycle, investors who have mastered technical analysis and risk management have consistently outperformed retail investors who simply chase rising and falling prices. Now, let's examine how interest rate cuts impact market sentiment. The market interprets rate cuts based not only on the policy itself, but also on market expectations. Following the dot-com bubble of 2001, rate cuts were viewed as a desperate attempt to stabilize the market, leading to a subdued short-term market response. During the 2008 financial crisis, however, the Fed's rate cuts marked the beginning of a bull market, shifting market sentiment from panic to gradual optimism. In 2019, the market interpreted the Fed's modest rate cut as a continuation of policy easing, which directly drove the S&P 500 to a new high. Clearly, there is a strong correlation between rate cuts and market sentiment. Now, let's return to Powell's speech. The Fed sent dovish signals, hinting at a possible 25 basis point rate cut in September. Data shows that U.S. non-farm payroll growth has plummeted from an average of 250,000 jobs added per month to fewer than 150,000 jobs added per month, while the unemployment rate has risen slightly to 3.9%. Although inflation has fallen to around 3%, it remains above the target rate. Given the current environment of moderate economic growth and a declining inflation trend, a precautionary rate cut is appropriate and short-term market optimism is justified. Technology and small-cap stocks have rebounded first, which has benefited gold and real estate as well. However, highly indebted companies should exercise caution. Historical experience tells us that investors should pay special attention to the dual nature of interest rate cuts. They can signal economic stimulus or warn of an impending recession. The key to making this judgment lies in the macroeconomic context and the market's actual reaction. If the rate cut is precautionary, the market will often react quickly. If it is reactive, however, the market may initially decline before rising. A rate cut is merely a signal, and how it is interpreted and responded to is crucial. Based on historical and current circumstances, I offer the following investment recommendations. Maintain a core position in high-quality technology stocks or index funds for the long term to ensure stable returns. Flexibly allocate tactical positions to interest-sensitive assets, such as gold, real estate, and cryptocurrencies, to seize short-term opportunities. Use technical stop-loss orders and phased position building, and continuously monitor market sentiment to mitigate potential risks. Use market breadth, trading volume, and the VIX index to determine market authenticity and avoid blindly following trends. Pay attention to sector rotation, prioritizing technology, small-cap stocks, and financials, and considering real estate, gold, and cryptocurrencies as secondary opportunities. Be cautious with highly indebted companies. Finally, I want to emphasize this point. Interest rate cuts aren't gifts, they're tests. True winners are not those who get excited by news of rate cuts, but rather those who understand the logic behind them and develop sound investment strategies based on macroeconomic data and technical indicators. History has proven that investors who can distinguish between precautionary and reactive rate cuts during cycles of rate cuts and seize key assets and tactical opportunities ultimately achieve steady returns in both bull and bear markets. Okay, that's all for today's video. If you found it helpful, please give it a like to support the channel. Don't forget to subscribe and turn on notifications so you won't miss my latest updates on the market and investment strategies. I'd love to hear your thoughts. What do you think the market will do next? Let's learn and grow together in the comment section. Thank you so much for watching. See you next time.